Okay, very good morning. It is Monday the 29th of January, so I hope you all had a fantastic weekend. Briefing for Monday, as always, is a bit of a recap of a lot of major headlines from over the weekend, and also we'll have a look at some of the main things for the week ahead. And I'm not sure whether you guys have checked out the economic calendar for this week, but it's one of the most busiest weeks that we've had so far this year. And obviously this year has been already very good in terms of market movement comparative to last year. So going straight into the charts and having a look at how things are set up this morning, and then we'll go through some of the main headlines from the weekend. And fairly tame open overall, but fixed income futures are quite a bit lower is the one observation that we're seeing this morning. T-notes down about 10.5 ticks. Bunds also, you can see here in the bottom right, just gapping down beneath that low that we printed at the tail end of last week. And consequently finding some resistance here, initial bund movement since the UX Open this morning on that support point, going back to what would have been last Thursday session. Comes amid slightly firmer equity markets. You can see here on the center left, the DAX future trading in slight positive territory, having found a little bit of support around the pivot this morning. Euro stocks likewise up slightly. US futures, a little bit of a mixed picture. The Dow slight positive, the S&P and Nasdaq slight negative, but nothing really too huge in move. And I guess the slight drift off here that we have seen in the S&P is not wholly unsurprising given the just run up that we had. If you check out what happened on Friday's session, we just really motored to the upside, particularly in the last hour of trade on Wall Street. I mean, check that out. We went from 28.64 all the way run up to pretty much in the last part of trade we got up to close to 28.80 where we peaked overnight in Asia. So a bit of profit taking there, I think, given as we'll go through this week there's a lot of things coming up for the week ahead. So obviously people just taking some of the position off on those longs that may have been in play. Elsewhere then, gold continues to track lower. But obviously it does come in a longer term context of a really strong rally that we've had in gold ever since Will unfortunately got out of that position. He's still got someone? Oh, he's got back. He managed to reevaluate and get back in, because it was quite an odd thing actually when looking at just quickly this dip that we had in gold. When it broke back lower through the support point of really October of 2017, you see it ran lower down to a low point of close to 1236. That was kind of when Bitcoin was rallying at the time, and that was when Bitcoin, people were talking about 20,000, 50,000, 100,000, 1 million, you know, where's the top? And obviously since the one thing that happened mid-December, of course, was the major global exchanges, so in particular the futures contracts on CME went live, and ever since then really the price has stabilized quite a lot. I mean, when I say stabilized, we still see multiple digit percentage moves, but nothing to the same sort of size that we had been seeing. And there was a pretty strong inverse relationship at the time between Bitcoin gains and gold losses. But since Bitcoin has stabilized, one thing that we have seen obviously is this talking down of the dollar, and we're going to look at that a lot more in this briefing. But obviously if you were looking at the kind of trend that has been in line, then you know this ascent of the dollar has really helped catapult this gold price higher. And we've gone from really sub 1250 all the way up to 1350, and you can see here finding some resistance back around the 8th of December high that we printed in 2017, which was a year-to-date high of 2017. Quite interested to see how the market has responded to that, back actually to just looking at this trend line from those original lows. So again, the gold price very much supported by the ongoing persistent weakness of the dollar, which the Dixie, of course, has traded at a 3-year low. Having a look elsewhere, though, in the major currency pairs, the dollar obviously has taken a big hit. Last week, Stephen Mnuchin, the Treasury Secretary, was kind of the main catalyst, but also followed up the whole administration seemingly talking down the dollar as they go into this kind of protectionist mode and a lot of key trade talks that are upcoming. The dollar, though, has rebounded slightly as of this morning. We're up about 0.2, so consequently both pairs under a little bit of pressure. Having a look at cable, though, firstly. Cable is down about 34 pips, but again, in context, we've had such a powerful run higher in the price of cable. Then again, a little bit of just coming off the top here isn't massively surprising. The one thing I'd say is that I do think that irrespective of this pullback, in terms of the week in its entirety, I would be looking for the cable to be supported, particularly if we did come back down to that 140 now. I think that's a pretty good support point for the market to remain long at this point, because in terms of Brexit real headline risk, I don't think that really is going to materialise substantially until we get closer towards that end of March key trade talk EU summit on the Brexit negotiations. Talking of, though, pound, there are a couple of things from the weekend's press for you to be aware of, and this is the headline being run by a lot of the newspapers, is mounting pressure on Theresa May. This is kind of probably the most repetitive theme that we've had the last, I guess, 9 months of UK politics. She's coming under pressure because there's been calls at the weekend on the likes of other more Brexiteer type leaning Conservative members to basically sack the Chancellor Philip Hammond. So Philip Hammond, obviously in charge of the economy, has taken a little bit more of the perspective of remaining in the single market, the customs union, to the benefit better than of the UK economy. But this obviously flies against then what the mandate is of the UK government, which is to deliver, of course, Brexit. And so, again, fighting on multiple fronts is Theresa May, as critics inside her governing Conservative Party threaten to upend her plans for Brexit and even her premiership. There's said to be, again, a growing sentiment amongst the more conservative-leaning lawmakers about her lack of leadership and potential vote of no confidence. But one thing I would say with this, I mean, it feels like we've been here about 5 times before, questioning that of Theresa May's in terms of ability to lead the Conservative Party. I don't really think this is going to amount to anything. I think this is kind of the status quo, and I don't think this is really a big part of why the cable pair's a little softer this morning. I think that's more to do with the dollar seeing a bit of recovery after being beaten down last week. One thing you might have seen at the weekend as well was this. This was the latest ICM survey conducted or commissioned by The Guardian at the weekend. And in summary, if you exclude roughly the 1/5 who do not have a view, then basically Britons favour a second referendum by a 16-point margin now, or at least having a say on the final deal in terms of the public getting a say, not just Parliament. We did hear from Jeremy Corbyn. Actually, he's been a couple of comments being rerun. I think he spoke yesterday, but from this morning, talking about the fact that Labour, don't want that at this point. But some of the interesting statistics from this latest poll show here that Remain leads 51 to 49% if we were to have another referendum as of right now. Now, don't be fooled, because that percentage, that minor 2% lead to Remain, actually is exactly what it was on the referendum that happened in the summer, in June of 2016. So we all know how wrong these polls can be. I'll see if I can dig out, but what happened post-referendum is a lot of these pollsters went through a recalculation of their kind of methodologies to make it more accurate, to kind of pick up on the failure that they had from the referendum. So it'd be interested to see whether that methodology change has been factored into these latest numbers. But some of the key things here, just quickly to show you, is about how Brexit views are shifting and becoming more polarised among some groups of voters. And in summary, what's happening is younger people are getting ever more vocal about Remain, and older people, plus 65, are more pro-Brexit than they've ever been, ever since this whole issue kind of has come about. And so you can see here students plus 16. Now, this obviously is a very key demographic, because going back to the referendum, the participation was nothing in comparison to what we had in the general election, which followed in April of 2017, of course, and that was when Labour made substantial grounds purely on or heavily on the back of cultivating sentiment to get the younger demographic to vote. So this could be a lot different, but the one thing that has happened as well is that Labour voters have lost a little bit of that kind of thinking, particularly of the kind of real mainstays of the kind of northeastern England view, which was quite heavy for Leave, areas such as Sunderland, for example, which were in excess of 60% to Leave. What we are seeing is more and more Labour voters are shifting to Remain away from Leave. The one thing, though, on the flip side, is that more and more Conservative members are just getting sick of the situation and want a Brexit. And so it's very finely balanced at this point. Putting this into context, though, of this week and today's market price activity, this whole Brexit talk I don't think really is the mainstay of what we should be focusing on. I still think at this point in time, if you're looking and trading the pound, what really is important is the movement of the dollar. That's what's really key at the moment, because it's the dollar that's been driving both currency pairs, not just cable, but also Eurodollar of late. And that's the real story here at the moment. And as I said, Brexit on a timeline is really going to heat up and come back to the forefront on the hierarchy of events when we get closer towards end of Feb and then into March. One of the other things then, talking of the weaker dollar, this was an interesting infographic that I saw this morning, and it's looking at a study from ING analysts this morning, and it's looking at the change in real dollar trade-weighted index during a president's term going back to the 1980s in percentage terms. And then in a nutshell, what it's saying is the US dollar tends to suffer from a second season syndrome under Republican presidents, falling on average 3 to 5% in the second year of the term. However, it does tend to then revert back towards the democratic level of the dollar when it starts coming towards the end of the administrative period at back end of year 3 and year 4, if that makes sense. And so a couple of things here just to be aware of. Typically Republican administrations such as what we are under at the moment are worse for the dollar, especially during the second and third years of a 4-year presidential term. In practice, that sees Republican administrations shift from a strong dollar policy embraced by the Democrats to a policy that FX rates should be freely determined by the markets. Now, there has been a historical precedence of when the US have tried to talk down the dollar. This actually came when the newly elected President Clinton tried to prise open the Japanese auto market back in the early 90s. His Treasury Secretary at the time, a chap called Benson, opined that a weaker dollar would help narrow the US trade deficit with Japan. Now, not only did the dollar actually weaken, but treasuries and the US stock market sold off, and a sell America mentality was born. So it is an extremely tricky one to balance in regard to trying to play this game, if that is what is materializing, of trying to verbally talk the dollar down without being to the detriment of other US assets. At the moment, that hasn't occurred. Obviously, what has happened is US equity markets have continued to surge, but an interesting point here is that maybe this weakness of the dollar isn't that unusual, because there has been historical political precedent set, and this isn't abnormal for a Republican to see the dollar weaken only then to revert back in about another 12 to 18 months' time. And especially given the fact that if you think about the US and monetary policy going forward for 2018, what we are expecting then is that the economy is going to pick up, inflationary conditions are going to increase, and therefore, net result, the Fed are going to continue tightening policy. And if that does all materialize, then this should translate into a stronger dollar going forward. Okay. Having a look what the weaker dollar has meant elsewhere. one thing that you can see quite clearly here, and really you could map a similar type of graphic for gold as well as WTI crude. Now don't get me wrong, for crude there are other things at play. There are some of the rebalancing of the market from a supply and demand situation. There's the ongoing supply cuts that are in force between OPEC and non-OPEC, and their commitment continues to remain steadfast at the moment to maintain production at levels to underpin the rise in prices. Global economic growth is getting better, but one of the key things here is quite a strong inverse relationship at the moment between the weaker dollar, as defined here by the blue line, and then oil prices continue to be supported. And so, of course, oil here still up at around these 3-year highs. And just looking at the dollar on a daily continuation, you know, we are clear of those key technical levels. Now, that break of the what was summer or kind of end of Q2 highs that we printed in 2015 was really key. You can see there we initially broke through the level, came back to test pretty much to the T, the same break at 62.56 on the daily charts here. Before then, the concerted push higher. I would say probably 65 is another good level to keep an eye on, because you can see here on the break of that level we ran up to around that price point before coming back down. We've broken there, come back down to test it again before the next push. Technically, there doesn't seem much in the way of really a continued push higher, with kind of 70 being the logical target, with not a great deal of technical resistance coming into even above there at this point in time. So the weaker dollar definitely will be a key thing to watch to see whether or not that can continue as a trend. Looking elsewhere, this is one of the other major headlines that we've had. This is a comment by Klaus Knott. Let me transition my screens. So Knott is the Dutch representation in terms of the governing council, and the European Central Bank has to end its quantitative easing as soon as possible, according to Klaus Knott, who said there is not a single reason anymore to continue with the program. And so extremely hawkish comments here from Knott, but I know you guys are all familiar with your policy stances by now, but just to refresh any of you who need a quick snapshot, this is the ECB hawk-dove scale. And as you can see quite clearly, after Weidmann Hansen, Klaus Knott is the third most hawkish member in terms of the ECB's governing council, so really unsurprising. But having a look at the euro-dollar pair this morning, it's not really in an area of too much to excite, but obviously this continuation of the trend that we've had, really quite roller coaster ride we had last week amid what was anything less dovish ECB press conference. They kind of towed the line, and some were looking for potentially Draghi to talk down the euro. That didn't materialize. That was the power up. We got up to highs of 125.77. We then had Donald Trump come out, and after an entire week of talking down the dollar, he said, you know what, I like a strong dollar. The dollar's going to become good in the end, and then euro dollar flash lower. You know, but I guess this is just kind of, I think people read between the lines when it comes to Donald Trump now, and we retrace that move pretty quick. The broader point being here is that the euro-dollar pair still remains highly elevated in the context of where we have been since the beginning of 2018. And so for the moment, I would say still the preference would be for euro-dollar to remain supported with eyes really on the dollar. Near-term levels, I'd want to keep an eye on that initial kind of S1 level. You've got a bit of a support zone there on the intraday between S1 and then the initial flash low on the strong dollar comment from Trump at the end of last week. Any break below there, then I'd start looking down at the kind of high that we printed back on the 16th. And you've kind of got this consolidation of price action, so that S2 and just below there looks quite good as a support point given the recent highs you can see back mid-month in Jan, also on the 18th, 19th, and then before the eventual break. So kind of levels on the weekly that I'll be looking at, still with the prevailing theme that that the euro-dollar pair should be still supported at around these levels, chiefly because of the weaker dollar. Okay, quick look at the week ahead, and first of all starting with the daily chart. Now there's not a great deal coming out this morning, so as ever for any of the newer trainees, what you should always do is plan and look ahead for the week in its entirety, so that you can know how to kind of almost allocate your kind of mindset as well as your trading opportunity and your capital to know where the greatest kind of risks or catalysts for market movement might occur. What we're looking at today then is very much so, a dollar-centric day, because we've got US PCE numbers coming out this afternoon, so that's going to be 1:30. And that's really where the balance lies. So you're probably going to have to wait until the US come into the market and the data's known before we start to see really better flows come into the market. So today is actually a fairly quiet day, but looking on the weekly calendar, this is a really interesting week for several reasons. For one, if you are trading the loonie, and I did have a question actually from one of the trainees last week, why is it called the loonie? Well, that's because of the loon, which is one of the most common birds in Canada, and it actually appears on the Canadian currency on one of their coins, so hence the loonie. But you've got the 6th round of NAFTA talks that continues. So if you're looking at the peso or the CAD, then something just to be aware of. The last comment that I saw from Trump on Twitter was basically he said, I could do a deal on NAFTA, I couldn't do a deal on NAFTA, I might not do a deal. So there's nothing really too much to take from him at the moment, other than he's kind of hardballing the situation. But the CAD and the peso do remain susceptible to potential weakness should he up the aggressiveness of that trade talk. Going on to Tuesday then, a couple of interesting things here. And one is, just quickly to give you an overview of the week in its entirety, you've got a lot of corporate earnings. In fact, you've got 120 S&P 500 companies reporting this week. So just to give you a run through of the highlights, you've got Pfizer, McDonald's on Tuesday. It's very much a tech-centric week, so all the big market-capped tech names are reporting. Wednesday you get Microsoft, Facebook, supposed to be eBay, not Bay, AT&T, Boeing and PayPal. Thursday you get Alphabet or Google, Amazon, Apple, Shell, Alibaba, and on Friday you get kind of what is classically the tail end of earnings season in the US. You get the energy majors, ExxonMobil, Chevron. You also get Merck as well. So a lot of corporate earnings to also to consider, particularly on the tech front. So just be mindful each day as we become, particularly on Wednesday and Thursday, a bit of divergence at market opens between the Nasdaq and the other US major indices. Going forward then, you have ADP, employment change of course on Wednesday. This is the prelude to US non-farm payrolls on Friday, and if I remember rightly, I think the consensus for the headline figure there very much is the typical kind of 180,000 in job creation. But remember, it's not the level of jobs that created is key, it's the wage number that is absolutely influential at the moment and will be in focus and what will define the market's reaction, because that is the key look and insight into the inflationary conditions, and that's what's the most instrumental at the moment for market sentiment and belief about what the Fed might do with their policy going forward. Other things, you've got manufacturing PMI data coming out as well from Asia through to the Europe, UK and the US. You've also got a variety of different speakers coming out throughout the week, and probably one of the ones we'll have to keep an eye on very closely is this one on Tuesday. So tomorrow you've got US President Donald Trump giving his State of Union address, and although there is no set topic for that at the moment, I would imagine you can expect him to talk about the performance of the US economy, record highs in US equities, corporate tax cut delivery, and probably infrastructure spending, things like this. So that's going to be a key one to watch, and that's going to be on Tuesday, so we'll look at that in more detail tomorrow. Okay, going to wrap it up there. I'm going to have Sam, he'll provide a couple of charts in the chat if there's anything interesting that he has been looking at this morning, because I'm aware of the time and want to get you guys stuck into the market. So any questions, let us know in the chat room on Trading Live. And as I said, Sam will also be available. So have a good day, a good week ahead. And that full calendar that I just overviewed there at the end of the briefing is available in your inbox. Okay, guys, thank you very much. And have a good one.